What's up, guys? This is Nick coming at you with a bit of a recap, a bit of an update on my own personal trading journey. As you can tell from the title, March didn't go all that well for me after having a really cool month in February, honestly. March brought me back down to earth with trading a little bit, which is a good thing because it gives you opportunities to grow. And I think I always look at these moments as opportunities you look back on in 2, 3, 4 months' time and go, that was actually a bit of a turning point. So that's a really good thing. Obviously, I'd prefer it to have been a really cool month, not just to share with people. I don't care too much about that. I prefer sharing when I do poorly because it actually does better on YouTube. People like seeing other people fail, which is funny. But for me personally, I would love to be able to make a huge amount of money month on month trading. Now, although I don't want to make excuses, a big part of March being not good for me was a lot of misfortune at different times. I was trading my strategy in two different ways, against the direction of the market and with the direction of the market. One of those kind of stopped working, which I'll go into a little bit more detail. And I also went through periods where I would size up to trading minis and then size back down to trading micros. Every time I sized up, I go into drawdown. Every time I sized down, the strategy would work. And that wasn't just performance based, it was actually the numbers. It showed that we went through the biggest drawdown actually my strategy's ever had, which still isn't that big, but right at the point that I increased size. So really frustrating in that in that sense. But at the same time, like I said, it opens up a possibility to actually look into what I'm doing, because towards the end of the month, I did begin to go, this probably isn't the most efficient way of trading. After the FOMC meeting a week and a half ago, we've actually had some really big moves, and not only was I not able to take advantage of any of them, I was actually taking losses on those days, which was really frustrating to see. And it made me step back and go, there's probably a better way of doing this. And I did a lot of work over the past week. I really went down the rabbit hole with some strategies. I looked at scalping approaches. I looked at all different types of things, and was very close to saying nothing really works on the NASDAQ until eventually I came across some really interesting videos that have pushed me towards a complete variation of what I'm doing right now. But we'll jump into the journal. We'll talk through what happened in March, and we'll go through what my plan is. I know that checking out other traders and seeing how their journey goes is really interesting, so I hope you do find this interesting. If you are considering getting funded with a prop firm, because that is what I'm doing, check out the link down below. Even if right now you're not thinking about it, there's a link down below to my website, and I update that every month with the best discounts that I can get on Bullnox. Bullnox are the prop firm that I'm with. I have not had a single problem with them. The problems have come from my end with some poor performance and my strategy not working all that well. But we'll go through all of that. But make sure you check it out if you are considering joining. Check out the link down below. And yeah, let's get into it. So many of you will have seen this before if you've seen my videos. This is my journal. I might make a video at some point on how to create this kind of journal, because I think it's really helpful. I have screenshots of all my trades, as well as grades and accuracy and all of that. So maybe for another time. But I'll just give a brief sort of overview. In the first couple of weeks of the first week of the month, I went through this really unfortunate period where I would take against trades, and I call them against trades when it's against the direction of the market, and they would cost me quite a bit, and it would actually prevent me from taking trades in the direction of the market with direction. And I began to see this. Let's just move my face a little bit, and it looked like this. So this is a breakdown of all my styles of trading. So this is when the market is strong and I go with the market, weak goes with the market, strong going against, weak going against, and so on. So what I was finding is that the against trades really were not performing very well at all. They were giving a very small return, and we were actually at a point, this is the against trades here, where this was around late January, I think. Since late January, they've actually just broken even. So I was kind of at this point like, yeah, we probably need to stop trading these completely. Compared to the trades where I'm going with direction, much better performance. So at this point, I decided to change that after March 6th. Unfortunately, I had missed out on taking a number of really good trades, which would have been very profitable. The big problem that I began to see at this point, however, was my with trades I would actually go double size with. So the against trades I go one mini, and the against trades I would go 2 minis if I was in profit on the day. And what that meant, if I show you here, is that the overall return of the strategy was kind of inflated quite a bit. Up here you can see it's made 201R in 179 trades, but that's because 182R, in other words 90% of my profit, had come from the with trades, and they were going at double size. So once I got rid of the against trades, all of a sudden I was in this situation where I was going to be making half the profit that I was expecting to. And that's not an ideal situation. You can see here the expected return monthly, and this hasn't actually been fully updated. Maybe this one has. Yeah, this one has. So you can now see that over all of the data, that's expected to return around about 22R per month, which is a good return. But the problem is that means we're slipping very close to the threshold of what I consider a profitable enough strategy to trade. And it really began to hit me quite hard, and I realized maybe the drawdowns are now going to be a bit bigger because I'm only taking the with trades, and some of the drawdowns in the past were made bigger by the against trades, some were made smaller. So there was a bit of a mind fuck, honestly, around all of that. I made a video on this period here where I traded really poorly. I actually kind of semi fell out with my trading buddy at one point. We essentially, well, I was very against a certain trade. He was very for it, and then we went back and forth, and eventually we kind of both came to the middle and ended up taking the trade, which was the wrong approach. Should have done the opposite. That sent me on a bit of a spiral, and I made a couple more mistakes. And then after that, you can see my performance has actually been really good. After that trading error, my performance, which is the A, B, or C, has been really, really good. Unfortunately, from the 10th to the possibly the 14th, 10th to the 15th, I went actually to this trade, funny enough. So for these trades here, I sized down. I was trading 2 micros on my account, which these ones here, sorry, which meant that I made a much smaller return than I would do normally. And as you can see, that's 2R, 4.5R, 7R, 5R. So I made 5R worth of profit, but only trading 2 micros. And then I went back to trading with 1 mini for these trades. And as you can see, although initially we made 5R, I then lost 1, 2, 3, 4, 5, 6, 7R in a row, which has not actually happened. I think it's happened once before in all the data I have. And that was enough to actually blow one of my accounts. So it was really frustrating that the moment I sized up, that was the case. Had I kept at the same size, this period here where I made the 5R in here, this would have been enough to put my account higher, which would have meant that 7R wouldn't have taken me below my stop threshold. Now, after this, there were a couple more losses, and I got really close, but it then went on to make a few more winners. So a very frustrating month where it just felt like when I sized up, it would go wrong. When I sized down, it stopped working, and it actually began to affect me a bit mentally as well. It's never nice when you go through that. The only drawdown, I will say, of the funded accounts is that you have that trailing stop. It does play on your mind a little bit. It does mean you shouldn't really be trading as big a size as I am. Went through that. I still stand by the decision that I had. Is what it is. It's a shame. And this kind of, just proof is here that over the course of March, even though I blew an account, technically I was break even for the whole month, and that was with a bunch of mistakes and also trading the against trades. And we can see that my strategy overall, if I just bring it up in here, I haven't actually checked. Well, I might have done actually. The overall return of the strategy in March for just with trades would have been 17.5R. Now, unfortunately, a very large chunk of that was during that first week where I couldn't take some trades because I was already stopped out, and that meant that I couldn't take advantage of those moves, and it cost me a lot. Now, that being said, the big thing I noticed, and I'll bring over TradingView real quick. I'll get rid of the drawings. The big thing that I noticed was that during the days after FOMC, we had some really, really nice volatile, well, not even volatile, but we just had a really nice trading range. We had big moves up, big moves down. On the next day, we had a bit of a choppy day, followed by a big sell-off day. And these are the days where you really want to be taking full advantage of. And I actually made a video on this, it's possibly the last video I made, saying you can identify where key levels are, and when they break, they give big moves. We had one just yesterday where we took out these highs. And as a result, once we got above those highs, take the replayer off. Fine. Once we got above those highs, we gave an insane move higher. And when I added the one entry that I got on my strategy on Friday, it was like here. I caught one part of the move and that was it. If I had literally gone, I'm just going to buy at my moving average on these days that I know there was a big move and gone for an 80-point target, I'd have been hit once. I actually got a second one up here as well, which just missed stop and going on as well. So despite having a bad month in March, it actually really opened my eyes to there being potential for growth here. So what I'm going to do is I'm going to get rid of my face now. So I hope you enjoyed that. And I'm just going to show you the new approach that I am going to start taking. And it's a strategy that, I'll be honest, I found. I'll put a link to the guy I saw on YouTube because I think, being honest, I think it's the best video I've actually ever seen in the Nasdaq about trading. So he's awesome. So I definitely encourage you to check that out. I'm going to show you my variation of this trendline strategy. So if you're interested in what I'm going to be trading in the future and a strategy which I think is really profitable, stay tuned. If you're just interested in seeing how shit of a month March was, feel free to stop. But please don't follow this through, because this strategy here, from the testing I've done, has incredible potential. Harder to trade, but yeah, we'll go for it. So this is just a basic trendline strategy. And what you do, you need to first of all determine whether we are trending or in a range. And something that I had never actually considered using before was the 4,000 tick chart. And the tick chart, I'll bring one up real quick for anybody who's not seen one before. The thing I love about it is that it flattens out the pre-market. It flattens out the pre-market and after hours action. So on a minute or an hour chart, each candle represents 1 minute of price. With a tick chart, it takes 4,000 ticks. So what that means is that this period here, from this line here, this is market close on whatever day this was, to market open here. So this represents hours and hours of price, and it's condensed it, and it makes it very obvious that we had a pretty bullish move during the pre-market. And I really like the way it condenses price. It's like I said, I'm sure some people are saying, why these are the best charts to use for trading futures. I don't know if they are or not. But I do love the way it condenses price down. It gives a much clearer idea of the way the market is moving. So the number one thing that I do is determine whether we are likely to have a trending day or a range day. This is going to determine our initial entries. Are we trending upwards, for example, and then we're looking to buy pullbacks? Or do we look at it and go, we're likely going to be in a range today, so therefore I want to short off of the pre-market high or high of day when we get there? So that's the first thing. The big thing that my strategy, I think, fails at slightly is it doesn't take advantage of the days where it's really trending. And it also potentially gets into a bit of trouble on the days that are ranging. It kind of is, the way it's designed, you're most likely going to short near the lows and go long near the highs, anticipating a further move. On a trending day, that means that quite often you're getting in after a lot of the move has happened. And during a ranging day, it means you're getting in right at a point where it's reversing. Not always, it still has a really good win percentage, but I did begin noticing it was doing that a lot. And yeah, if we're ranging, then we can create a trend. Oh, sorry, if we are ranging, then we can still create a trending day. And we again just want to use a 4,000 tick chart. Maybe after 2 hours of trading, we've got a range, we've got a trend forming on the day. these are the things that I always want to have marked on my charts. The pre-market high and the pre-market low. If we are in a ranging environment, then this is pretty key to know this is a potential reversal zone. And even if we've been trending higher, if the pre-market high was, quite a bit higher and we get a nice move into it and then reject it, it's an area to notice. Same as well for high of day, low of day. Again, these are areas for potential reversals, and also the higher time frame trend line if there is one. The reason I see this is that whilst doing my backtesting, I noticed that I was quite often just trying to catch a direction and just go long if it was bullish. And what I realized is that quite often that a higher trend line, higher time frame trend would break and would get a pretty clear signal that we should begin looking for shorts in that instance, and I wasn't really paying attention to them. So it's really important to have that on there. And yeah, always being aware of these to help the analysis of price action. Again, my strategy didn't really care too much about price action, and that's probably a oversight / laziness on my behalf. So when is a trade valid? Are you going to use the 4,000 tick chart to determine if a pullback is valid? So if I am in a bullish market and I'm looking for a pullback to go long in, that pullback has got to be at least 5 pullback candles on the 4,000 tick chart. The reason for this is that during really volatile periods, this will give me trades earlier. And in quieter periods, it means I'm not going to get faked out on these sort of like shallowish trend lines that are formed on the 1-minute chart when there isn't really anything going on. I also want to use the 4,000 tick chart to determine when we have a double top or double bottom. Often, again, the 1 minute, if we have a low volume periods at high of day, we end up making these very weird looking double tops that are just kind of part of a choppy range. And that could just be consolidation for the next breakout. Easy to get trapped in. The 4,000 tick chart tends to show them pretty cleanly. So that's, I think, a big advantage. And then finally, using the 1 and the 3-minute chart to determine the higher time frame trend breaks. I am going to continue to test this because one thing I've noticed, I'll bring over the 4,000 tick chart again, is that when you have a higher time frame trend direction, and that is essentially when you just have a longer period and it's not a pullback, when these break on the 4,000 tick chart, they do actually normally give pretty clear moves. You can see a few of them here. So this is something that I'll be testing, throughout. Doesn't, there's so many different ways to trade. It's just figuring out which one I like the best, really. So keep on looking at that, but I like looking at the 1 and 3 minutes at the moment. Now, what determines an entry for a direction or a reversal trade? I'm going to be using the 1-minute chart to draw a trend line. Going to keep adjusting that because the key thing, and I'll show you an example of this, is to have an entry, we need to have a strong candle that breaks with close to a full body before we get an entry. I'll show actually what that looks like right now because that can be a little bit confusing. If we had, for example, draw this channel in here because I know this one was a valid one. What I'm looking for is a candle to break out of this range, out of this channel, with a full body candle closing without much of a wick. And if it is a strong candle, but the wick closes, then it doesn't count. So in this instance, I would move the trend line to cover this wick, and then this would be my my trigger entry. Another example would be this flag here, where we get this trend line down here, and we would not get a signal on this wick here. We would move it, and we would get a signal instead on this full-bodied candle. And I really like this approach. This is the main thing I learned from the video that I'll put down below. I think his name is 1 Minute Trader. When you have a trend break, it's actually really important to not just take a random wick as a break. You need to have that confirmation of strength. So in this example here, although this one would have ended up working out, I would not have got a trigger because every time we adjust it, now we've got another wick, and then you adjust it again, now we've got another wick, and then we adjust it again, now we've got another wick, and by this point we're not really in a pullback, we're more in just a range. So yeah, that's kind of like the important element to the strategy, waiting for that signal. So if I'm going long, it has to be above the 16 EMA. I use 16 EMA just because I've used it on my old strategy and it seems to work pretty nicely. being completely honest, the 20 EMA probably works exactly the same. I just have the 16 because that's what I had on my charts at the time, and it seems to work nicely. I'm going to enter either on the open of the next candle. So if we have a candle, it pushes up, and I'll show you again just to get that example. If I get use this down here. So we have a trend. Put this in here. We get that strong bodied candle break. I will be looking to enter on the next candle, so long as my stop isn't that big. So down here, like I'm risking to lower this candle or a little bit more. 9 points, that's absolutely fine. If, for example, we weren't entering until that candle didn't close until up here, well, now all of a sudden I don't want to be risking, say, 26 points. So what I will do is I will say this is where I want to put my stop. For me to have my risk, let's say I'm going to go 25, but just to make it more visual, let's say I wanted 20, I would wait until we pulled back to that level. So they're the two types of entry that I'll be going for on this strategy, on this version of strategy at least. And yeah, so if it's less than 25 points, enter on the next candle, and if not, then we set a limit order to get a better price with the risk no greater than 25 points. And the risk should be fairly tight, like I showed on there. It should be, it should be like, okay, we're getting in here, and I'm risking a very small amount to try and make quite a decent return. For the higher time frame break and retests, this is when I've got that longer time frame trend. For this, I want to use the 3-minute chart and use it in the same way to identify when we have the break. However, after that full-bodied candle close, instead of looking to get in straight away, I'm going to look for continued momentum for it to then retrace back to either the 16 EMA on the 3-minute or the trend line. I want to add a couple of candles bouncing off of these areas to enter the trade again with tight stops. And the reason for this is because I have quite often seen longer trend lines breaking with a little bit of strength for like a minute or two and then coming straight back, and it ends up creating this false breakout. There's still a lot of buyers coming in, and you end up seeing shorts getting stopped out. So I'd rather wait for a little bit more confirmation on those higher time frame breaks. Now for sizing, I'm going to have two sizings. When when the risk is less than 13 points, I'm going to go with 2x size, and when it's 13.25, I'm going to go 1x size. And for exits, as the price moves in favor, I am going to adjust my stops fairly slowly. I'm not a massive fan of moving my stops immediately to break even. But once I've got a point where we've had let's say I'm long, we've had a solid, 10, 15 points in my favor, then I'm going to begin moving my stop to at least the low of, say, a candle that I entered in, or maybe another candle. And then we pull back, put in a higher low, then I'll risk to around that, the low of that pullback. I am not going to move my stop to anything more than break even. I'm not going to put it into profit. For me personally, whenever I do that, I end up cutting a lot of trades short, and I would rather, and the data is just showing that it hits my targets like comfortably often enough, so there's no need to do that. And speaking of which, my targets are going to be a minimum of 1 to 2, but if we have a bigger move potential to the high of day, low of day area of loss, support resistance, and aim for bigger risk rewards. For example, on this one here, we're risking 9 points, so the minimum is 18 points of gain. Obviously, I'll go 2x size on this one, but we can actually go for this area of previous price action in here, so we can actually go for the 3 to 1 in this example. And then finally, I think one really important thing is to look at the potential weaknesses. I think that I'm going to fall into the trap of looking too quickly for a pullback. I also think in backtesting, we're always going to be prone to best fitting strategies. There's a pretty strong likelihood that I disregarded some setups because they didn't work. But if I was to be trading them live, they would be legitimate setups. And I think amplify that with, the fact of we're looking for trades quite often. That's probably going to be a weakness of mine early on, so I'm being aware of that. And then also not noticing the change of price dynamic. I have never been incredible at reading price movement, or I'll rephrase that. I've always been, I'll bring my face back in for this bit actually. I've always been okay at reading price action. I have then not acted on it. So quite often I'll be like, I can clearly see that we have stopped moving higher, but hey, my strategy is giving me a long setup, so I'm going to take a long. The real key with this is to understand when the price dynamic changes from incredible move move up to chopping around to stop looking for those pullbacks to go long and actually start looking for reversals or just to hold off and wait for a clear setup again. Now, I am not going to be trading this immediately with any size, let alone trading with minis. A big thing, one of the courses I actually created was the trading blueprint. It's what I use to get funded, get to a point where, and one of my funded accounts, for the record, is still live. It still has, like, I think over $1,000 of profit in it. And as I showed you with the strategies, I didn't actually lose money in March in terms of R's. It was just the fact that I kept on sizing up and down at the wrong time. So I still feel that, like, if that's a bump in the road for me to have a break-even month, that's a pretty good sign. So I'm going to go back and use the essentially what I did in the past to get to where I was with that strategy. It's a course that I created called the Trading Blueprint. It's on my website. Check it out. It's got nothing to do with strategy. All right, it's all about the process that I've used myself. I've used with clients for coaching mental game and psychology issues. It's essentially a blueprint to saying, okay, you've got a strategy, you've got an idea. How do you turn that into profit? I proved it using my old strategy. I'm going to prove it again with this strategy because I know that there's going to be a lot of things I haven't factored in for yet. And the first step of that is actually, now that I have backtested and got the results, is to actually paper trade it for probably 2 weeks. Maybe not quite that long, we'll see. And the reason that I'll paper trade it is not to see if I'm making money with it. It's to find where I'm weakest. It's to make those mistakes. I always ask my clients, when are you most likely to make mistakes on any journey? And it's right at the beginning. So there's absolutely no sense in me going, okay, I'm going to jump in, I'm going to start trading live size on my funded account to try and make money when I know I'm going to make a lot of mistakes. There's a strong probability that my first 20 trades, I'm only going to be at around about 50% accuracy, which is probably not even break even. And that's fine because that's where everybody starts out when they start trading a new strategy. A big thing I've actually seen recently is people jumping to a new strategy or new approach and just trading how they were before. I kind of look at it as a case of trading's a very competitive professional performance environment. Think of it as if you were an NFL quarterback. You've got new plays in your playbook. You've not even ran through them in training. Maybe you ran through them once, and then you're in the playoffs, and you're going, okay, let's run this play that we haven't even practiced. It makes absolutely no sense, and it's why so many traders fail. So I'm going to use paper trading to get to a point where I am executing this at a really high level. And then once I'm executing at a high level, I can then be very honest with myself and say, okay, I think I'm executing at an 80-85% accuracy level like I was with my old strategy. Am I making money doing so? And if I turn around and say, yeah, you know what, in the last 30 trades, I've traded at an 85% accuracy and I've made 20R, 15R, 30R, whatever it would be, I can then very comfortably say, my execution is good. When I execute good, there is profit. Then you go into a live market. So that's really what I'm going to be doing. I'm not going to be updating you on paper trading because it's not real money. But that's what stage I'm going to be in. And hopefully at the end of April, I'll be able to share an update again on where I'm at. And so long as this strategy isn't it hasn't just gone through 3 weeks of, oh my god, it's worked and it's never ever going to work again, and I haven't completely screwed up the backtesting, which is always a possibility. As long as I get my execution good, hopefully at least by the end of the month, I'll be trading this for real money and have some more updates for you. So thanks very much for watching. Make sure to check out the links down below. If you've made it to the end, drop a comment and let me know how your March went and also what your plans are to improve for April. Hope you all had a great month and have a really good next few weeks, and I'll see you again in the next video.